Welcome to the Simply Safe Dividends channel. I'm your host, Brian Bollinger. After some head fakes over the past year, interest rate cuts are finally on the horizon. Inflation has cooled, which has given the Fed enough confidence to adjust its policy, with a series of rate reductions expected to kick off later in September. This chart from Morningstar shows that rates set by the Fed went from near 0% at the start of 2022 to over 5% where they've held at since last summer. But the futures market and Morningstar expect rates to begin moving towards 3% over the next year and potentially even lower from there. The pace and size of rate reductions will ultimately depend on how well the economy holds up, but past rate cutting cycles have helped some stocks more than others, and falling rates will reduce the income paid out by money market funds and CDs. If you're starting to think about how you might replace some of that income, or you're just curious about which stocks could do well in this new environment, I thought it would be fun in today's video to look through Warren Buffett's portfolio to see which of his dividend-paying stocks have historically performed the best after rates are cut. Using the portfolio tracker on our website, Simply Safe Dividends, I plugged in all the stocks and treasury bills owned by Berkshire Hathaway, which is a public company Warren Buffett controls to buy and manage his assortment of businesses. This portfolio contains over 40 holdings that have a combined market value of more than $500 billion today, but I want to clarify that this does not include Berkshire's privately owned companies like BNSF Railway, Geico Car Insurance, Electric Utilities, and even Dairy Queen. I'd guess those businesses could be worth a similar amount to the firm's stock and T-bill holdings, so it's important to keep that in mind when you're looking at Berkshire's portfolio here, since it doesn't paint a complete picture of Buffett's diversified empire. Starting at a high level, you can see that Berkshire's portfolio yields only about 3%, but its massive size means that it's still enough to generate over $16 billion of income each year from dividends and interest, which is more than the market caps of popular companies like CarMax, Texas Roadhouse, and the diversified REIT WP Carey. Inside the income calendar report, we can see how this income stream breaks out, and the numbers here they're really eye-popping, with bigger positions like Apple and American Express paying Berkshire about $100 million of dividends each quarter. There's also Chevron and Coke at nearly $200 million of quarterly dividends, but the biggest contributor by far is U.S. Treasury bills. When you buy a T-bill, you don't receive a regular fixed income payment, but you pay less than what the bill is worth at maturity, and you get to pocket the difference, which in Berkshire's case here amounts to more than $10 billion of income each year at today's rates. To put some perspective around this figure, I'll go over here to our diversification report, and I'll take a look at the income tab, which shows me that T-bills are responsible for over 65% of Berkshire's income, whereas no single stock pays dividends that account for more than about 5% of the portfolio's total. I'll dive into the dividend stocks in Buffett's portfolio in just a minute, but I want to first mention one thing about Berkshire's large T-bill stake, since I've seen some clickbait articles out there saying that this must mean Buffett thinks the recession is on the way or the market's going to crash. There's really no merit to this line of thinking, since Buffett has said many times that he has never made a decision based on an economic prediction. I also put together a chart that shows how Berkshire's allocation has changed over time to treasury bills, cash, bonds, and stocks going back to the end of 2017. Stocks are represented by the light blue bars at the top and have consistently been around 60% to 70% of the overall portfolio. They're a touch lower at 55% today, but really not far off from typical levels. The main reason for the recent drop was Buffett's decision earlier this year to reduce his stake in Apple by about 50%. Since this position was roughly half of Berkshire's stock portfolio, that increased cash and T-bills. You can also see that the orange bars, which represent investable cash, have shrunk in favor of treasury bills, which are in dark blue along the bottom. This makes sense since cash earns nothing, while T-bills now offer a 5% risk-free yield after the Fed's rate hikes. If you're wondering why Buffett sits on so much cash, it's really because Berkshire prefers to be an opportunistic acquirer. Whenever the tide goes out, Buffett wants to be the one that good companies call when they fall in hard times and need capital, or they might be more open to making a deal. Outside of those circumstances, there just aren't that many public or private companies that are big enough to move the needle for a company of Berkshire's size and that are open to being acquired at a reasonable enough price. So Buffett, for now at least, is happy to sit on a pile of cash that exceeds $230 billion, and it's earning a 5% plus yield. Much worse places you could be than that. That being said, Buffett focuses on owning high-quality businesses, so it's still an interesting exercise to see which of his holdings could be better positioned to do well when the Fed starts lowering rates this time around. This chart from the Hartford Funds plots the level of the Fed's short-term interest rate over the past century and shows the 22 rate-cutting cycles that have taken place over that time, with the yellow dots marking each time the Fed started to lower interest rates to try and support economic growth and avoid a recession, which is indicated by the gray bars. I'm going to start by looking at the 1995 cycle when the Fed only ended up cutting rates 3 times and managed to avoid a recession. This type of soft landing scenario is what many investors hope will happen this time around. We looked at each current Berkshire holding that was publicly traded back then, and we calculated its total return over the 1, 2, and 5-year periods that followed the Fed's first rate cut back in July of 95. I flagged the S&P 500 and Berkshire in black so you can reference those as benchmarks. This period was great for many financial stocks, with Chubb, Bank of America, and Citigroup each returning around 50% in the first year, which more than doubled the S&P 500's gain of 19%. Falling rates helped the outlook for these businesses because they encouraged companies to take out more loans, and they helped support higher asset prices. The resilient economy also kept credit losses low while keeping demand rising for many different insurance products. Apple was the main outlier here, as the company was flirting with bankruptcy throughout part of the 90s, so its weak return during this time was more related to its own issues rather than rate cuts. If we do get a soft landing with even more significant rate cuts than what we saw in 1995, I think a case could be made for history to repeat. Many financial stocks have been beaten up the last few years as a surge in rates has increased the competition for deposits among banks and squeezed their lending margins. Getting some relief here while keeping credit losses low would help restore their earnings power, especially for regional banks that have been hit the hardest and are more dependent on their loan books compared to diversified mega banks like JP Morgan. The 1998 rate-cutting cycle was similar to 1995 in that only a few cuts were made and the economy avoided a recession once again, but there were some more concerns this time since Asian markets were facing an economic downturn, Russia defaulted on its debt, which hurt investor confidence around the world, and a major hedge fund called Long-Term Capital Management nearly collapsed. Unlike in 95, fear of financial market contagion hurt insurance stocks like Chubb and Aon as the value of their investment portfolios came into question. I was also surprised to see Coca-Cola near the bottom of the list here with a 16% loss in year 1 after the first rate cut, since this is a defensive stock, but I think investors were worried about its emerging markets exposure since Coke had a big footprint over in Asia. There weren't many winners to look at in Buffett's portfolio following the 98 rate cut, but it's a good reminder of how quickly sentiment can change for certain types of businesses. The next rate-cutting cycle came in January of 2001 as the bursting of the dot-com bubble was underway. This was a vindicating time for Berkshire and other value-focused investors after they had badly trailed high-flying tech stocks for several years. But the collapse of these speculative investments and the negative impact they had on investor confidence, as well as corporate investments, tipped the economy into a mild recession. During this period, diversified banks and insurers benefited a little bit from lower rates, like they did back in 1995. Moody's also saw a nice jump in demand for rating new debt, as many companies looked to refinance existing loans at lower interest rates. Energy stocks also did relatively well since geopolitical tensions tied to the 9/11 attacks and just general unrest in the Middle East led to worries about oil supply disruptions, which pushed oil prices higher. On the losing side, credit card issuers American Express and Capital One are more sensitive to economic downturns since consumer spending falls and defaults on credit card debt spikes. Next up is the big one, the 2008 financial crisis. The Fed's rate cut started in September 2007 when it was becoming clear that the housing market was in trouble since many borrowers with poor credit were defaulting on their mortgages as home prices fell. The value of many financial assets collapsed and caused banks and other financial institutions to suffer huge losses. Citigroup, Bank of America, American Express, and Capital One all significantly underperformed the S&P 500 as their credit losses swelled, and stocks tied to home building like Lennar were also crushed. Insurance companies like Chubb did surprisingly well, probably because their focus on commercial insurance policies and their disciplined underwriting insulated them from the subprime housing crisis. Berkshire's financial strength also helped it outperform the S&P 500 during this period, and it was able to scoop up some opportunistic bargains like its investment in Goldman Sachs. Other winners were companies that sell recession-proof products like Coca-Cola and Diageo. The last and most recent rate cutting cycle we'll look at started in 2019 when there were signs of slowing global growth caused in part from a U.S. trade war with China, but inflation had also remained stubbornly below the Fed's 2% target, which certainly feels like a bygone era these days. This cutting cycle was really unique since the pandemic arrived about 7 months after the first rate cut in July, so it's not one I'd really read too much into. During the depths of the pandemic, you saw a lot of financial and energy companies lose out as government-mandated shutdowns froze major parts of the economy. The businesses that did the best were really those that were deemed to be essential and could stay open, like grocery chain Kroger, or companies that sold goods that were in higher demand from consumers who were locked down at home. This includes everything from Apple's iPhones and grocery products from Kraft Heinz. If there's one message you get from this analysis, it's that there are really no clear signals on what will happen after rate cuts. What happens in the stock market depends primarily on whether the economy has a soft landing or tips into recession, but those events are nearly impossible to predict with any sort of consistency. If there is a recession, I'd bet on some of Buffett's classic defensive holdings like Coca-Cola, Kraft Heinz, Kroger, and T-Mobile doing well since they all sell essential products. If a soft landing plays out instead, the financial sector could stage a nice relief rally as pressure on deposits eases, lending margins widen, and credit losses stay low. This could help companies like Citigroup and Ally Financial. Visa and MasterCard could also be interesting as borrowing costs come down and a stable economy continues supporting growth in consumer spending. At the end of the day, I'm with Buffett that long-term investors really have no business making decisions based on a prediction about the economy or where rates will head. I prefer to stay focused on quality companies that seem likely to be larger and more profitable a decade from now, and that maintain financial strength to get through the next downturn whenever it hits. I'll stop there, but I hope this video gave you some helpful insights into rate cuts and Buffett's portfolio. If you enjoyed it, it would really help me out if you hit the like button and considered subscribing to our channel, which will stay focused on dividend stock analysis and income investing tips. If you have your own dividend portfolio, you might also be interested in checking out our website, simplysafedividends.com. You can find research and tools that thousands of investors rely on each day to keep their dividend portfolios safe and keep their retirements on track. The site's free to try and it lets you track your portfolio's safety and income. You can read our stock research, screen for ideas, download our newsletter, and model portfolios, research a company's fundamentals and valuation, and a whole lot more. Thanks again for watching, and I hope to catch you next time.